Welcome to EconTalk, part of the Library of Economics and Liberty. I'm your host, Russ Roberts of George Mason University and Stanford University's Hoover Institution. Our website is econtalk.org, where you can subscribe, find other episodes, comment on this podcast, and find links and other information related to today's conversation. Our email address is mail@econtalk.org. We'd love to hear from you. Today is November 1st, 2011, and my guest is Stephen Kaplan, the Neubauer Family Distinguished Service Professor of Entrepreneurship and Finance at the University of Chicago's Booth School of Business. Steve, welcome to EconTalk.
Thank you. Good to be here.
Our topic for today is what might be called the super rich, what gets called sometimes the top 1%. Sometimes we're going to look at the top 1/10 of 1%. And we're going to organize our conversation around a paper that we will link to that you've written with Joshua Rao called Wall Street and Main Street, What Contributes to the Rise in the Highest Incomes. It was published in the Review of Financial Studies in 2009. There's a lot of evidence that the richest Americans are richer than the richest Americans of the past. I phrase it that way because it is important to remember that in most of the recent discussions of inequality, and it's a very hot topic right now, we are typically not talking about the same people. So when people say the top 1% have gotten richer, that does not mean that somebody in, say, 1980 necessarily has more, who was in the top 1%, is now making a lot more or has a bigger share than they had in today than in 1980, because they're taking a snapshot, a slice in time of a segment of the income distribution in 1980 versus today, or today versus 1995. So that's a really important distinction. I'm sure we'll blur it because of the nature of the English language, but I want everybody who's listening to remember that that's what the data are literally measuring when we usually are talking about the top 1%. There are data that look at the same people over time, and they, by the way, often get a very different pattern of who has gotten the gains and the relative amount of inequality over time. But we're going to stick with the standard view, which is that we look at a snapshot in time today versus a snapshot in time a while back, whether it's 15 or 20 or 30 years ago. The people who are in the top 1% or the top 10th of 1% have higher shares and typically make more money, or sometimes a lot more money, than the people who were at the top 1% in the past. So how much has changed? How much richer are those folks at the top compared to the folks at the top a while back?
So the comparison I think that most people focus on is if you go back to, say, 1980 or the late 70s, the top 1% earned roughly 10% of the adjusted gross income in the United States. So the way this is usually framed is in terms of income shares, and it's pre-tax income, it's adjusted gross income, so no taxes. But in the late 70s, early 80s, it was about little under 10% of adjusted gross income, and it peaked in 2007 at roughly, well, not roughly, exactly 23.5%. So if you look at pre-tax income of the top 1%, went from under 10% to 23.5. Now, what's interesting about that is the 23.5 in 2007 was the second highest on record. The highest and highest still is 1928, where it was 23.9%.
Ah, the good old days.
The good old days. Now, it's not comparable because I think taxes were much lower back in 1928 than they are today. So after tax, you might get a different answer. But pre-tax, it was, very high historically. Now, what's interesting, in the last 2 years, it's come way down.
Yeah, recessions are bad for the rich, and that if you care about inequality per se, recessions are great.
That appears to be true. So in 2009, the top 1%, I calculated at 17.6. I've seen other calculations a tad under 17, but it's basically gone from 23.5 to 17. And what's interesting about 17 is that inequality in 2009 is actually lower than it was during any year of Bill Clinton's second term.
Interesting. Now, when we talk about the top 1% of adjusted gross income, what is roughly included in that measure of income? It includes, obviously, earnings that you earn in your paycheck, but it also includes capital gains, right?
It includes
dividends,
earnings,
everything.
Capital gains, and it wouldn't include interest income, for example, on municipals. It would include gains from options, gains from partnerships. So it includes quite a bit. I think the one thing it doesn't include that, some people get a fair amount of income, or at least they used to, is income on municipal bonds, although that's gone down quite a bit as interest rates have gone down.
Yes, right. So the trend overall, like take out the recession. Actually, I should say first, I want to quote P.J. O'Rourke because I think this is also important to keep in mind and often forgotten. He says, wealth is not a pizza. So if somebody gets a bigger share of the pizza, it doesn't mean you have less to eat. So for example, when that share fell from, say, 23 point something to 17 point something over the 2007 to 2009 period, that wasn't good news for the rest of us in the 99% because our incomes also went down. Theirs just went down a lot more.
Correct.
So a lot of people, again, as an economist, I find it deeply annoying, and I find it particularly annoying when economists do it. But there's a big difference between wealth is not income is not a zero. We're talking about income. Income is not a zero-sum game. Somebody else's gain does not come at your expense. It could, and I assume we'll talk later about when it does. But in general, these numbers don't have automatic implications for the 99%.
No, I mean, clearly in 2009, a falling tide sank all boats, right? And at least on the income share side, it hurt the top worse than it actually hurt the bottom.
When you said all boats, you meant most. Of course, there are a few industries that thrive during bad times. Economists being one of them.
Okay, excuse me, most.
I knew what you meant.
Thank you very much. You are being precise. Most boats. Thank you.
Well, I knew what you meant, and I think everybody knew what you meant. But I always like to note the poignance that economists who most of us did not predict the recession. Those of us who did, I think, were mainly lucky. And who don't seem to have a good, clear picture of how to get out of it are the ones who are benefiting the most. So there's an irony there, a tragic irony. So of these folks, what's it take to get into the top 1% approximately? How much adjusted gross income do you have to have? And remember, this is adjusted gross income. It's after some deductions for the standard deduction. What else is deducted from it? So it's not your raw income.
No. Adjusted gross income doesn't have any. Taxable income takes out the standard deduction. Adjusted gross income is before any deduction.
Okay. So that's good. How much do you have to make to get into the top 1% today?
So it varies, and it was. I would say it's around somewhere between $300,000 and $400,000. And again, it varies from year to year. In 2007, it was over 400,000. In 2009, you'd be, probably the lower end of 300,000. And
again, this is income, not wealth. So the assets that get you to the top 1% of the wealthiest Americans would be a very different number.
And that's very much harder to calculate. Because, income we can measure pretty well thanks to the IRS. Wealth is very, very hard to measure. It's based on surveys, and you don't necessarily know whether you're getting a representative sample. So I think Ed Wolf at NYU is the big guy on wealth distributions, and the data are hard. I'm trying to think if I can find that, but I don't have that on the tip of my tongue. Although it looks like sort of for wealth, the top 1% looks like somewhere between $5 and $10 million according to his estimates.
Now, how about going back to income? how much income do you have to earn per year to get into the top 1/10 of 1%?
The top 1/10 of 1%.
So this is 1/1000th, the top 1/1000th of the American income distribution.
There we're looking at again in 2009. It was on the lower side. It was roughly, actually less than $1.5 million, so it was like 1.4 million.
A mere 1.4 million.
A mere 1.4 million.
What was it in 2007?
In 2007, which was our peak year, you had to turn over $2 million
to get into that more elite class. Now, Paul Krugman recently blogged. I forget where he got it from, but he recently made the observation that I think is true, that much of the gain in the income share of the top 1% is actually accruing to the top 1/10 of 1%. I forget over what time period it is. Like, I want to say at least the 90s and the 2000s is my memory. I'll put a link up to it. But
this is not so clear. So let's look. Let's go 2000. I like to stop at 2000 because this is a fun one. 2000 was the last year of Bill Clinton's term.
It was also the year before the recession of 2001, so it's a little bit of a mini peak.
And there, the top 1% had 21.5% of income, and the top 0.1% had about 11.
So half of the top 1% went to 1/10 of that group.
Correct, and that seems to be about I'm looking at the pattern here. That
is that
seems
true in 2007?
Pretty consistent over time. In 1980, the top 1% got 10, the top 0.1% got 3.5. So in 1980, I guess it was 35%, and more recently it's been close to 50%. So his point that it's gotten more skewed is correct.
What about the 2007? Do you have that?
So the 2007, it was basically 23.5 and 12.
Yeah, about the same as it was in 2000.
And then in 2009, interestingly, 17.6 and 8. So 2009, the very top took the biggest hit in some ways.
A little bit, but it's still about half.
Yeah, it's still about half.
I remember now his data showed the share going to the top 1/10 of 1% starting around 1995, and a year that I think is somewhat significant. We'll come back to that later. Could be a coincidence or a post hoc ergo propter hoc analysis on my part, fallacy. But I'll challenge you with it and see what you think. So what you've done with those are all preliminaries. I want to talk about your work now with Joshua Rao. In your study, you made a very heroic attempt to figure out how many. Almost literally how many, and certainly rough percentages, where do those top 1% and top 1/10 of 1%, what are they doing? Where do they come from? What are their occupations? We have an idea of what classes of occupation industries these folks are found, and you tried to actually measure it. So it's easy to throw around, and I do this myself. I should be more careful, but it's easy to just say, well, we know that there's a bunch of different groups that are really rich, entrepreneurs who own their own companies, CEOs, hedge fund managers, investment bank execs, athletes, celebrities. But what we really care about, one really important thing to know is how important are each of those groups, because I feel very differently about a great athlete like Albert Pujols, who's going to make a lot of money next year, already makes a lot of money this year, and is in the top 1% and is going to do even better than he has in the past probably, versus somebody who through corporate financial manipulation or government policy is able to exploit leverage and bailouts and get people to lend him money at cheap rates, et cetera, et cetera. So what do we know about the mix of people in that? What have you discovered about the mix of people in that top 1% and top 1/10 of 1%?
So the motivation for that paper came from listening to, whether it was pundits or even some academics say that, income inequality was largely driven by CEOs and public company executives who were, getting paid huge amounts.
Ripping off shareholders.
And they were ripping off shareholders. They were controlling their boards, and there was no governance. and that the corporate governance system in the United States was broken. And the argument those people made, again, is that everyone else is paid on an arm's length basis. The CEOs are the only ones who they control their boards, they set their own pay, and there was this view that they were out of control and driving everything.
It just keeps going up and up because it can, and all the social forces that used to restrain it aren't there anymore. And that's one argument you hear.
Exactly, and I serve on a couple of boards. I teach people who are on boards, and I had a more positive view of boards. I think that, or at least thought at the time, that many boards try to do the right thing. I had a view that there was a market for CEOs, and had a view that CEOs are paid a lot, but it's a really tough job, and they maybe should be paid a lot. So what Josh and I did was we looked at all these other groups to see to compare how the CEOs did relative to those other groups. So
and thereby figure out how much they contribute to this issue.
Yeah, and so the hard part about the paper is that you have this great data on what top executives are paid, because you have to top executives of public companies what they're paid, because the SEC requires you to report that. You don't have such great data on everybody else, and so we cobbled together whatever data we could to do a comparison. So we looked at investment bankers, and we looked at public filings of compensation from the top investment banks. We had to make some assumptions, but we attempted to generate how many of them were highly paid. Then we looked at hedge funds. Hedge funds grew enormously in terms of assets under management from 1990 to 2007 and even today, although it's come down some since then. We looked at private equity investors and venture capital investors. Private equity also, the assets under management in private equity have grown tremendously in the last 20 or 30 years. KKR, Carlyle, Blackstone famously with Steve Schwartzman. And so we attempted to estimate, we know the fees that are paid for hedge funds and private equity funds, and we could make some assumptions about how many people were highly paid. There's actually reasonably good data on professional athletes. Yep, so we looked at professional athletes. And there's some data you can get on lawyers, top partners at law firms, and we looked at those as well.
And there's some obvious categories you don't have data on. So you don't have doctors, I think you mentioned. You don't have privately held firms, principals and executives and owners, et cetera. Obviously, some entrepreneurs then are not going to be in the mix.
Correct, and closely held businesses, which are before they go public.
And listeners can go look at the paper. For some of the estimates, you had to make some somewhat heroic assumptions. Others, you had pretty good data, and it spoke for itself more or less. Having done all that, what part of the universe do you think you captured? What's your estimate of what part of the top 1% you actually were able to observe?
So at the end of the day, we think we captured somewhere, depending on what percentile you fall upon, but like from the top 0.1% to the top 0.00001%, we got somewhere between, say, 15 and 25%. So let's say 20. We got 20%, we think.
Meaning, and I want to make sure this is important, let's say it's 20% is what you think you got. Uh-huh. That means that 80% of the people we've been talking about, you didn't observe. They're from categories that you don't have, but are you pretty sure that of the 20% you did observe, you've got most of the hedge fund managers, Wall Street execs, CEOs, athletes, et cetera?
I suspect we were conservative throughout, except for the public company execs we had pretty perfectly because they filed. I think on the others we erred on the side of conservative. So I don't know. Let's put it this way. I doubt if we're at 20 that we can sort of put our fingers on. Even if we were more aggressive, my guess is we wouldn't get above 30.
But
which is where you're going, I think.
No, it's not. I'm just curious whether whether the missing groups are within the categories that you're looking at, or all pretty much outside the groups. Do you think you've got most of the hedge fund managers that are important, or just have I know you have more than 30. I assume you have more than, like you said, you have.
I think we probably have a lot of that. The hedge fund, private equity, we're probably pretty good on. We probably don't include some money managers who we didn't, I think, put in that. Those were harder to get numbers on. And the public company executives were pretty good on. My guess is the lawyers were pretty good on. So I guess, the celebrities I suspect were light on.
That's where you miss. Yeah, you probably didn't have Kim Kardashian in your survey.
Exactly. And we only had 100, making more than $1.4 million, which I think is almost definitely on the low side.
100 celebrities. Yeah.
Again, the top celebrities, you rely on things like Forbes lists, and they don't, there are a lot of people who go missing from that.
And I mentioned Kim just because, we're close friends, and I'm sure she'll be on EconTalk soon. No, I'm kidding. I mentioned her because today we're taping this on a day I think we just came out that her marriage tragically is over. And for those of you who pay attention to those things, you can go look at it. I happen to have noticed it.
Actually, I've never watched the show. So
yeah, I missed the whole thing. I was getting a haircut this morning. They had it on the background, and my heart goes out to them. But at any rate, but she made a lot of money evidently on that experience, so she would be in the top 1% this past year.
For certain.
Okay, so what did you find? What do you think? What are some of the patterns that were interesting, and what did you learn from them?
So, among the patterns that were most interesting is that the CEOs weren't unusual.
This is the CEOs of non-Wall Street, non-financial firms,
public
right?
Companies.
Yeah.
Were just not unusual.
Meaning?
In that their pay went up, but it more or less over time went up like the rest of the top 1% or the top 0.1%. So this view that the corporate governance is broken, that boards are corrupt, seems hard to understand when the CEOs are going up just like all the others. For example, lawyers, top corporate lawyers, saw their pay go up from, say, 1980 to date. Partners at top law firms have increased their pay by about the same amount as CEOs, or the same percentage.
Well, if it certainly is inconsistent with the theory that CEO pay at Main Street publicly traded companies is the source of the 1% growing. It doesn't refute the possibility that corporate governance is broken.
Well, you have to tell me for corporate. So I agree. Number one, it says they're a very small fraction of the total. So if what do we have, somewhere between 2 and 6% of the very top would come from public company executives. But the fact that their pay is not behaving any differently from the pay of investment bankers or lawyers suggests that, and it's they're all kind of in the same, being driven by similar forces.
Right.
Why would it be that if this one group, corporate boards and CEOs, are corrupt and are overpaying themselves? Why would they be being paid roughly the same as people who are getting paid through arm's length dealing?
Yeah, you think they could do even better than that if they were
exactly.
But of course, the cynic says, a particular kind of cynic, not my kind, but there are cynics who would say, well, yeah, they've all figured out, all these people at the top again, what Paul Krugman in this recent blog post called the oligarchy. They've all figured out how to exploit the political system to enhance their own, feather their own nests. It's possible. You'd have to.
It's possible. The other thing that strikes me there is hard to kind of reconcile with that is that, and this is more anecdotal than data because the data are hard to find, but you do see similar patterns all over the world. And you have, I certainly see it with my students who go to, whether it's London or Asia now. The pay at the top has, it's all these places for top talent do pay, large numbers.
So we'll come back and talk about alternative theories to that oligarchical explanation. But let's still stick with your findings. So you found that for the CEOs, they seem to be following the same pattern, which another way to say it might be that it suggests there's a market for very talented people, and they're part of that. They're not different. They're not manipulating the market.
That is basically the conclusion we came to.
And I'm sympathetic to that conclusion, so I want to push back against it in a little bit. We'll talk about that when we get to the theories. But what else did you find in the data? Some remarkable things about hedge funds. That was amazing. Talk about that.
This is one that was a lot of fun when you talk about it. But if you look at what the top hedge fund managers earn in, let's see, where's the number? In 2009, which was, remember, not a great year for the very top. There are estimates that the top 25 hedge fund investors earned over $25 billion.
$1 billion, and they averaged $1 billion apiece.
They averaged $1 billion apiece.
That's a lot of money.
It's
a lot of money.
A fair amount of money. And when you add up what all 500 S&P 500 CEOs earned, and the S&P 500 CEO in 2009 earned about $8 million each, which is a lot of money. But 8 million times 500 is $4 billion. And the 25 top hedge fund investors earned $25 billion. So that's 5 or 6 times as much.
That's a mind-boggling number. Some might say that it's more than enough.
It is a mind-boggling number. More, whether it's more than enough is that is, I guess, a value judgment. What we were, I think, more interested in doing rather than kind of thinking about the fairness issues, which are very, very hard to, I think, those can be argued many ways. We were really more interested in understanding, what could explain this, and what could explain what really is the pervasiveness of this increase at the top. So the CEOs went up, but they didn't go up any more than these other groups. The bankers went up. The hedge fund managers, obviously went up a lot. The lawyers went up. I think one of the amusing things about disclosure is that Eric Holder, for example, and the other people going into the government
Attorney
have to
General,
disclose what they earned.
Attorney General of the United States.
Eric Holder, the Attorney General of the United States, you know what he earned the year before he was Attorney General as a law partner?
Nope, I don't.
$3.3 million.
It's a good year.
He was a 0.1% kind of guy. In fact, that probably put him in the 0.05%, I would guess.
That might make him a little more sensitive to the problem.
So,
just giving him a shot. I'm trying my best.
What explain? And then the hedge funds obviously are, probably the outliers may not be the right word. The hedge funds are certainly at the extreme, and John Paulson had a couple of very good years where his 20% of the profits at his hedge fund were, well into the billions. Technology, globalization, and incentivization. So what are those three things? First of all, technology has changed tremendously over the last 30 years, particularly information technology, which allows you to scale your talent. So where do you see that? In the financial markets, with computers and computerized trading, you can push, billions of dollars around very quickly, and you couldn't do that so easily 30 years ago or 20 years ago. So technology allows, talent to scale. You see that in entertainment. So with, cable, which allows you to segment your audience and get your product to actually gets more product now to more people. That allows talent to scale. And I think that, for lawyers, you're applying your talent to bigger deals. Technology I think, has been very important, and it's been information technology, which has really helped people scale. The second piece is globalization. And again, it allows you to, if you have, if you're an investor, you can invest not just in the United States, you can invest globally. If you are a corporation, you can invest globally. It's allowed companies to outsource, and that also allows talent to scale. And then the third thing that I think has also increased over time is, call it incentivization, where hedge funds, the rise of hedge funds and private equity funds, the pay on that is, 2 and 20, but the key part is the 20, where you get 20% of the profits.
Explain the 2 and 20.
So the 2 and 20, which maybe 1 and 20, but it's the 20 is almost always there. Is that if you manage a private equity fund or manage a hedge fund, so if you're George Soros at a hedge fund or Steve Schwartzman at
Blackwell.
If you're Steve Schwartzman at Blackstone, which is a private equity fund. Now I'm babbling here. So if you're George Soros at a hedge fund, and if you're Steve Schwartzman at a private equity fund, people give you capital. So let's say you have $10 billion to invest.
Which we have to say, that's not easy to do. You've got to convince a lot of really savvy people that you're trustworthy with their money. So that's it's not just laying around.
It's not just laying around, but again, the scalability. There are large pools of capital now, whether it's pension funds, sovereign wealth funds, or whatever, that weren't so large 30 years ago. And that's partially due to technology, partially due to globalization.
Partially due to growth, yeah.
Partially due to growth. So you have these big pools of money, and when whether it's a Schwartzman or a Soros gets $10 billion to invest, the way they're compensated is they get an annual management fee, which is generally somewhere between 1% and 2% of assets under management. So let's say you have $10 billion, 1 to 2% is $100 to $200 million a year.
You're off to a good start.
So that's real money. And then you get 20% of the profits. So if George Soros has a good year and makes, let's say, a 50% return, so he's made $5 billion for his investors, he gets 20% of that $5 billion. So he gets the $100 to $200 million management fee, and then he gets $1 billion of the profit share, which is a lot of money.
And if it goes down and it's worth, say, $8 billion or $6 billion after a year or two, he still gets the 1 to 2%. It's a smaller number now because it's of a smaller base, and he doesn't get the kicker, right?
He doesn't. That's it.
And if he does that for a while, people start to cash out of the fund and don't give him any more money.
That is correct.
But you still have to ask the question, in a really good year, I make maybe 15 to 20% on my no-load index mutual fund. There are many years I don't get close to that, obviously, and sometimes it's negative. And I pay the mutual fund company a very small amount to do the indexed fund because it's very cheap. There's competition, et cetera. So the one puzzle is, first puzzle is, why is it that hedge fund managers are able to earn, obviously, if you can earn 50% year in, year out, or 20, let's say more likely, or even 10, people would like to give you money. And the question is, how are they able to do that? And how many people are able to do that?
So that's where the evidence is a bit unclear. On the hedge fund side, the evidence of consistent outperformance is actually pretty weak. So I think there are, some people who do that, very well, have some good years, and then they have some bad years. John Paulson is a nice example. He was the guy who made a huge amount of money on the mortgage debacle, and then he had another extremely good year. This year, he's having a terrible year.
But the puzzle is to draw skilled people into that activity. It's going to take into account that volatility, obviously, the rewards as people compete to try to. There are a lot of people who'd like to have that job. Another way to say it. A lot of people would like to be able to manage a few billion, even, let alone 10. And so they're offering their skills at. They'd be happy to take 0.5%. Instead of taking 2 and 20 or 1 and 20, they'd be thrilled to take 0.5 and 10.
Oh, why doesn't that happen?
Yeah. So does that happen? And if so, if not, why not?
Here's the problem, Ross, which is I do this in my class, and it's quite fun because this is similar in private equity and for hedge funds. Now, Russ, you would you'd be willing to manage money for 1%.
Sure.
Instead of 2 and 20.
Seems like a good job.
You'll take 1 and 10.
Yep.
Okay, so I ask my students that, and a few of them raise their hand.
I'm in. Yeah.
And then I say, okay, now switch positions. You're not a hedge fund manager. You're now a pension fund. Yeah. Are you going to give Russ money?
Yeah. But I'm cheap. I'm only going to take 10%, not 20.
No, and nobody raises their hand.
Correct,
and,
sure.
And you ask them why. And they go, well, if he was any good, or if he were any good, he'd be charging 2 and 20. If he's charging 1 and 10, he must be a loser.
And there's some truth to that. I would be a loser. But we know.
It's a market that clears. It doesn't clear on price. Because if you deviate downward, particularly on the 20% of the profits, that's a bad signal. You can lower your management fee a little bit. That's not, because there you're not aligned. But when you deviate on the carry, that's a bad signal. And so that I think is why it's very hard in these markets, private equity and hedge funds. It's very hard to deviate downward. You could deviate upward, and some people do. But deviating down is very hard.
But it also has to be the case for that story to work that there have to be a very small number of people who are capable of doing it. Because
correct. You're getting paid for talent. There's no doubt.
Because it begs the question: well, how to get to 20? Why don't they just make it 40? Why not go to what I ask my students is if it's just a signal, then you should charge 30 because then you'll get even more money because then people think you must be really good. And that can't be true, right?
Well, it does. In venture capital, that's what happens.
It doesn't keep rising, though. You don't.
No, it goes to 30 is about as high as it
right,
gets.
It doesn't go to 40. Yeah. You can't say, well, I'm even better than that guy who's getting 30. I get 40. You still have to have a track record. You still have to leave enough money for your investors relative to other alternatives that they're still willing to pay that premium.
That is correct.
And you have to recognize the fact is that although you don't want to give it to me and you rather give it to John Paulson, there are these bad years for him. And it means that a lot of times you'll give him 20% of your winnings in the good years, and in the bad years, he doesn't write you a check. He's always, I assume he doesn't pay 20% of the losses, correct?
That is correct. That's correct on hedge funds. Private equity funds are a little better, because the private equity fund typically is out there for 10, 13 years, and you do net winners and losers within a fund. So
That's different.
The incentive alignment in private equity is a little bit better to my mind than the hedge funds, but it's still the case that you can have one fund that's terrible and then raise another fund 3 years later that turns out to be great, and you don't net the first fund against the second fund.
Now, let me ask you a related question, which is not out of your paper, and if you don't know the rough magnitudes, we'll move on. But if we thought of three different parts of our capital market in America, the investment bank part, the hedge fund part, and the private equity part, what are the magnitudes, if you know, of how many people are in those businesses at the top and what share of assets of total capital they're allocating? Do you have any rough idea about that? Does anybody know?
So in our paper, our estimates were, about similar size. We had about 3,000 hedge fund investors in the top 0.1% and about 3,000 private equity and venture capital investors in the top 0.1%. So the numbers of people were the same. And what do we estimate for fees? The fees were sort of about the same order of magnitude. And this was 04, and the numbers might be 04 versus today, maybe a little bit higher. But what do we have? Sort of $25 billion. Yeah, so they must be higher because we only have $25 billion for the hedge fund investors overall. And we know the top 25 did that a couple of years ago.
And that tells you something about, obviously, how much money they have under management using these sort of
market. And as I said, we suspect we also we were conservative in the numbers we estimated for the non-CEOs. In private equity and venture, we had the same order of magnitude, 25, 30 billion.
And what about Wall Street? What about investment banks?
Wall Street, we had the same order of magnitude for the investment bankers, was 28 billion. So we had all three of those groups, in roughly the same buckets. I would say today, the investment bankers, have really been hit by both three things. The crisis has made there are fewer investment bankers, and the investment bankers that are left are not doing as well, particularly since they tend to be very pro-cyclical. They when the economy is doing well and markets are good, they do a lot more deals. So the bankers, I suspect, are down a fair amount. Hedge fund and private equity investors are probably about this, are still doing okay.
And when you said they're roughly the same magnitude, is it roughly right to say then that highly talented financial people on a per capita basis, those were total numbers for the groups, would the per capita gains to those folks and returns be roughly the same? You'd expect them to be if there is a market for talent. Obviously, somebody running a hedge fund could go work for a private equity firm. Someone running a private equity firm could go onto Wall Street. They obviously move around. They get specialized, but they have similar opportunities. You'd expect if there is a market, you'd expect them to have similar compensation.
Yeah, I think I'm looking now at the Forbes 400 in 2008, and this is corroborating to what we talked about earlier. I've got 27 hedge fund investors out of 400. I've got 33 private equity investors, and I've got 29 real estate investors. So roughly, the same number in the Forbes 400. And by the way,
that's wealth, right?
That's over 20%. That's like 89 out of the 400 in the Forbes 400 are hedge fund, private equity, or real estate investors.
And that's the Forbes 400. Is that wealth or income?
Forbes 400 is wealth.
Okay, so there's some alignment there then.
Absolutely.
So going back to the study, the CEOs you said did about the same as the total group itself. Were there any folks within the group who did particularly better than others? Were the hedge fund managers, are they all kind of moving up together, or is there some parts of the groups that are?
I think the hedge fund managers, they had this huge increase in the 90s. So my sense is both this would be true for private equity and hedge funds. The money under management, for example, in private equity increase, let's see, billions, from 1986 to 2005, increased by a factor of 30, 40 times. And of course, that was spread over, a number of people, but, there was a huge explosion in private equity, and there was also a similar explosion in hedge funds. Let's see, where's the money under management? $35 billion in 91 to the trillion in 2004, and that subsequently, kept on going. So the money, I think the hedge fund and private equity managers really, increased markedly over this period.
Which is
and more than the CEOs.
And much that's very, very good, right? We're thrilled that people are funding new ventures, that they're allocating capital if indeed they're doing it wisely. We want both that. We want that to happen, and we want the people who do it to do it well.
I agree. I'm a huge. I think the evidence on the private equity and venture capital industries is very good. So I've got some other research on private equity and venture. Private equity, actually, the returns there have consistently been better than the returns to the public markets, and that's net of fees. If you do it gross of fees, they've been a lot better. And that suggests that the private equity investors are actually making their companies more efficient. I think venture capital has not been great in the last 10 years in terms of what they've delivered to their investors. Venture capital was spectacular in the 90s, but I think the companies that venture capitalists fund tend to be the innovators that I think tend to have a lot of externalities that they don't capture.
And
so the short answer to your question is private equity and venture, I think, are actually quite good for society. The hedge funds are hard. The hedge funds are a little trickier, I think.
Well, they're doing a lot of different things, obviously.
Exactly.
But I think the fundamental point that I think should be emphasized is that unlike some activities in the marketplace, if you're really good at, say, funding new ventures or helping private equity enterprises, there's no limit to how much money people can give you. You will grow according to there is a market test is the way I would really say it. If you're successful and you're better than your peers, people will throw money at you. And
that is correct.
Some of it's luck, obviously. There's a role for randomness, obviously. You can be fooled by randomness. But in general, if you're consistently bad, you don't get to play.
That's exactly what happens in private equity, venture, and hedge funds.
So let's turn to Wall Street, and let me put a less cheerful hypothesis on the table and get your reaction. Starting in the 90s, most investment banks, I think almost all of the big ones, went public. Why that is a question. One of the things that changed in the 90s is we were in a period where it became more likely that the federal government would bail you out if you lent money to bad investments, as opposed to made bad equity investments. But by being a lender, starting with Continental Illinois in 1984 and then through the Mexican crisis of 95 and a little bit of, you could argue, long-term capital management, the federal government did not, for a whole bunch of reasons, but I'm not happy with any of them particularly, decided that lenders, if you were large, could get your money back 100 cents on the dollar. That surely made it easier to borrow and lend, and that made it easier to leverage capital in those in that activity. And that, in turn, made it easier for the executives in those businesses to gamble with other people's money rather than their own, unlike the hedge funds and the venture capitalists who were in private equity who were clearly taking equity stakes, not where they could lose everything. That suggests to me a depressing story where investment banks had a heads I win, tails you lose, lived in that world, and were able to grow very large and with much less risk to their individual well-being. And in turn, they allocated capital very poorly, trillions into the housing market, which many of them paid a very small price ex post. What do you think of that?
I am not a big believer in that argument. Where do I start on that?
It's a long argument.
First of all, the view that bankers, did heads I win, tails you lose, and that they thought that way, I think just doesn't make a whole lot of sense. You look at Bear Stearns and Lehman, Fold and Kane at Bear Stearns, Fold at Lehman. They both had hundreds of millions of dollars in Bear Stearns and Lehman stock.
They lost $1 billion apiece.
And they lost $1 billion apiece, and they surely would, I think if you asked them, would they do it over again? They'd say no way. And I think they believed in what they were doing, and I think they just didn't think that, what happened could possibly happen. They were surprised.
A strange defense.
I think that's true in general.
But that's a strange defense for someone whose job it is to not be surprised. The CEO of an investment bank. Let me take your example because I use them and when I write about it. Fold and Kane, the CEO of Lehman, the CEO of Bear Stearns, it's beautiful because they each lost about $1 billion when their stock values were wiped out, leaving them with almost the same amount as their paltry nest egg, a mere $500 million. Now, where did that come from?
Be careful. Where do you get the $500 million? This is where there's been a lot of misinformation. What are you talking about? The $500 million?
Happy to learn that I'm misinformed. But here's the way I have read the data. Their stocks, Bear Stearns, I think, peaked at 170.
Right.
And then ended up crashing at, I guess it started at 10, then they decided, or went down to 3, but close enough to 0 that that somebody who had held it through that ride lost a lot of money.
Right.
But of course, it bounced around a lot before that, and it bounced around a lot during that. Didn't go straight down, didn't plummet. Fold and Kane. They sold when they could, and they didn't put it back into their own company. They got
some bonuses and some salary.
And they didn't put it back into that one egg.
Here's the missing link, and this is Lucian Bebchuk has written this and makes this case. They took out about as much as they had left in, right?
And it would be gauche. It would be gauche to be running the company and have none left. So you couldn't sell it all, and there's literal regulation against it.
Let me tell you the missing insight there that Lucian and Lucian gave this paper at a seminar and was completely at a loss when I mentioned this.
Go for it.
Much of the equity that Fold and Kane received was in the form of options and restricted stock. Do you know what the tax treatment is of options and restricted stock?
I do not.
You pay ordinary income tax on that.
Okay.
And do you know what ordinary income tax rates are in New York City?
High.
50%. Federal, state, and local. Now, if you get $2 billion in restricted stock, what do you pay on that in taxes?
$1 billion.
$1 billion. And to pay those taxes, what do you have to do with that restricted stock? You have to sell it.
Right.
So if you sold $1 billion of stock,
which they did,
it went all to pay taxes.
Well, not all of it.
It did. The example I just gave you, all of it went to pay tax. If I got $2 billion of restricted stock,
right,
that's $2 billion of income. I owe $1 billion in taxes. I have to sell $1 billion of my stock to pay my taxes. I'm left with $1 billion of stock in the company, and that went to zero. I end up with zero.
So why did they sell their stock all along the way like that?
They did, to pay their taxes. So I'm not saying that they ended up with nothing. which is the extreme that, from the example I gave you, but they ended up with far less than people like you or Lucian think they did, because they're paying taxes of 50% on everything they've been granted. And so the bottom line there is that pre-tax, and these are the estimates, I think Lucian has pre-tax, they took out as much as they lost in the crisis, when the things crashed. But after tax, they might have ended up with nothing, but they certainly ended up with far less than you'd give them credit for pre-tax.
Well, the 500, I can't remember.
The 500 is pre-tax. That is pre-tax.
Well, that's not the way Jimmy Cain tells it in House of Cards by William Cohen. He's interviewed in there, and he says, "Yeah, I lost $1 billion, which is tough on my heirs, but he said I'm left with."
He says he's left with $500 million.
Yeah, so maybe, but so maybe he may, he's keeping score. He may have picked the pre-tax number for his own ego, and I'm willing to accept that that's an inflated number. It's a great point about the taxes. But go ahead. He also what?
No, go ahead. He was there for a very, very long time, but I guess Fold was too. Okay, that's point taken.
I don't know.
The estimates that Lucian would give you would be that it was $1 billion versus $1 billion, and Cain is saying $500 million versus $1 billion, although not all that $500 million is from Bear Stearns. Some of it's presumably from other investments. But fair enough. So the point is, the answer is not zero, which is the extreme I gave, but the answer is not the $1 billion that you started out with. And it really, so coming back to my main point, these people were not happy to lose it all.
Oh, no.
Certainly
no,
not.
They prefer to have rolled the dice and won. There's no doubt about it.
And then as you go lower down in the organization, the amount of money people had taken out actually decreases. So
that's interesting.
Remember who's making the decisions on all this. It's not necessarily the people at the top. It's the people, lower and lower down.
Correct.
And as you go lower down, these people, increasingly, hadn't taken much out and ended up losing, if not all, a huge amount or a huge fraction.
Well, going back to this question of, what's the right narrative, which is the way I tend to think about it. When these were privately held firms and they were investing their own money, they took less risk.
That is not true.
Not true? Okay, explain.
Let me give you a really interesting example, which goes to the story that I'm telling, that it was more or less the perfect storm, and they kind of got just
hubris,
surprised.
Overconfident. Yeah.
There was a partnership in the late 1920s that. Most of the partners, basically all the partners' net worth was invested in the partnership. And the partnership decided to put together a leveraged investment vehicle. They put up 50% of the partnership's capital into that investment vehicle. It was leveraged. They sold this in 1928. And when the market crashed in 1929, this partnership almost went bankrupt, took it more than 20 years to recover. And remember, this is partners own capital. There's no FDIC or anything. There was Goldman Sachs.
Yeah. And they almost didn't live to tell the tale.
Exactly.
Well, that happens. People make mistakes. That's true.
People make mistakes, and I think this is what happened in the 2006, 2007 time period, and it was exacerbated by the fact that the SEC let them take on more leverage.
No doubt.
And that I think was a decision in 2004 or thereabouts, where the leverage ratios were they were allowed to increase their leverage ratio substantially. But I don't think the view that it was heads I win, tails you lose, I think it just doesn't explain it, because this has happened. These sorts of events have happened really through all time. But, you had the Panic of 1873, very similar, people losing their own money. You had 1907, people losing their own money. You had 1928 or 1929, people losing their own money. And then you had 2007, 2008, which looks a whole lot like those other episodes. So I think, my view on this, the capitalist system, and for better or for worse, you get these periods where people become, whether it's overly optimistic or they, get, decide to take on, extra risk, and then they get things wrong, and you get a big downturn.
So you don't think that the policy response in the past 30 years to these failures, especially in 2008, where every financial institution that was large was bailed out 100 cents. Its creditors were bailed out 100 cents on the dollar, with the exception of Lehman and I think Wachovia, which I think the FDIC, I may have that wrong, but I did a podcast with Vincent Reinhart. There was one bank where the creditors, because it wasn't a Treasury Fed intervention, it was an FDIC intervention, they actually made the creditors take a haircut, that is, accept less than they were promised for fixed investments like bonds. You don't think that has made the probability of you don't think there's a moral hazard issue there? You don't think it makes it worse, or do you think it's just not big enough to explain the mess itself?
Yeah, I just don't think it's big enough.
But do you think it has an effect, or do you think it's irrelevant?
I don't know.
Okay.
I don't know. I mean, I'll tell you, another thing that was interesting about the crisis, in this regard, is that, obviously the mortgage-backed market, was the one that blew up, right? And that was, that'd be consistent with your story. But the leveraged loan market, going back to private equity, that market actually did just fine. There were, people were saying there were going to be a huge number of defaults by the private equity investors and by the private equity funded companies. And they just didn't happen because they learned their lesson in the late 80s and structured deals in a more responsible way. The heads you win, heads I win, tails you lose story would have said, you should have seen these problems everywhere, and you really just saw it in the mortgage market, which was, I think, was an innovation gone awry. The mortgage market and the CDS market, which both were innovations that were relatively new, and they, people got it wrong.
Yeah, it could be. Although, again, I would argue that I don't know any. Explain that leveraged loan market. I don't know, what is that?
Loans to leverage. People, were making, when you did a leverage buyout, and there was, record amount of leverage buyout volume in 06, 07, and 08, banks and other investors made, highly leveraged loans to the companies. And those loans, they were risky, they had high interest rates, and very few of them defaulted.
Right. So my explanation of that, if to be consistent with my story, would be that those lenders, and correct me if I'm wrong, have less political pull than the folks who got rescued in the bailouts of 1995, 84, et cetera. That they were not too big to fail. Is that not true?
I think that would be wrong, because I don't think they were. That's because the same people were buying them as were buying the mortgage stuff.
It is. It's the same large investment banks doing those leverage financing. Well, that's good. That's counter evidence. I agree with that. That's a really that's a provocative example. I need to look at. The puzzle for me is that I think, my favorite example is Ricardo Ribanato, who's the chief risk officer of the Royal Bank of Scotland. He wrote a beautiful book. I interviewed him about the book, but not about the crisis. His book is The Plight of the Fortune Tellers, where he explains how bad we are at estimating risk and how uncertain our understanding of uncertainty is, and how the value at risk model is we don't really understand it. And he writes that book, I think, in 05 or 06, and he's the chief risk officer. He wasn't fooled, but for some reason, when he tapped his boss on the shoulder, presumably his boss said, "Leave me alone." So maybe it was a human failing, but maybe the incentives weren't there that had been there in the past. That's what I find interesting.
Yeah, no, it's interesting. Although I would argue, the same thing happened in 1929, the same thing happened in 1907, and, they weren't being bailed out then. And that's, but, in all three cases, what would the right answer be? Higher capital requirements. So we would probably agree on the right answer. We might not agree on what's causing it.
Well, I hope we can come back and talk about that, because you've written some interesting stuff on how to reduce the probability of a future mess, and your own further thoughts on the crisis, which maybe we can talk about it down the road.
Good.
My guest today has been Stephen Kaplan. Steve, thanks for being part of EconTalk.
You are very welcome. It was fun.
This is EconTalk, part of the Library of Economics and Liberty. For more EconTalk, go to econtalk.org, where you can also comment on today's podcast and find links and readings related to today's conversation. The sound engineer for EconTalk is Rich Goyette. I'm your host, Russ Roberts. Thanks for listening. Talk to you on Monday.